I want to thank you all for joining us with the Great Choice Mortgage webinar. We are going to get started and explain why THDA made the decision to go to a new product. The Great Choice Mortgage Program is a different mortgage product than we have ever done before. In the past, most recently, we have always offered down payment assistance through the form of a grant. And by doing that, we considered those gift funds, but what THDA would do to the interest rate on those loans that needed down payment assistance would be increase the interest rate to offset those funds. In doing that, THDA could attempt to recoup those down payment assistance funds for future homeowners that may need those funds. This was not sustainable. The time it takes to recoup funds on a traditional grant down payment assistance loan is an average of 14 years. In the past 10 years, for those types of loans that we offered the down payment assistance grant, the average time those loans were either sold or paid off was 4 3/4 years. So you can see that we were not recouping those dollars being spent, and when we want to consider sustainability going into the future, we had to make a change. At the same time, with the interest rates where they have been for the past several years, which have been very beneficial, sometimes we have not always been very competitive with our interest rate, which would mean that a home buyer who really could have the benefit of down payment assistance might steer away from a THDA loan because the interest rate was not quite as competitive. By separating the down payment assistance into a second mortgage product at a 0% interest rate for a term of 10 years, we then do not have to increase the first mortgage rate to cover the down payment assistance. So we can be closer to a great market rate for the first mortgage, which is always a benefit to the borrower. So our interest rate will be one interest rate on a first mortgage, which we call the Great Choice Mortgage. Currently, that interest rate is at 4.45%, 30-year fixed rate. The second mortgage, as I mentioned before, is a 0% interest rate, and that is based off 4% of the sales price of the home, which is something different. What we had done before, we had gone up to 4% of the mortgage amount. But mortgage amounts change more rapidly during the processing of a loan. A sales price generally doesn't change unless there's an appraisal issue or some negotiating after a home inspection. But that typically happens before THDA sees the loan. So there isn't back and forth with the lender as much as far as fine-tuning the closing numbers. It's easier to do it off of the sales price than it would be off of the mortgage amount. So we did make that change. But what this product is actually going to do is going to offer THDA the ability to recoup these funds. That gives us sustainability in the future for down payment assistance. And how is this going to benefit the borrower? Well, you are going to have two payments. You'll have your first mortgage payment, you'll have your second mortgage payment. But that second mortgage, again, is only for a 10-year term. And if we look at the average loan that THDA has done, and this has been very consistent for the past several years, it's been approximately $110,000. If we looked at an example, the average principal payment on the average 4% of the $110,000 is about a $29 a month payment. That payment would be added to their first mortgage. The servicer would send them one envelope with two statements in it. The borrower can send the payment together and make one payment, write one check. If they do it electronically, the servicers are all prepared to do that. And the best thing about it is after 10 years, or at any time if the borrower wants to prepay that second mortgage off, for instance, if they got a tax refund, that $29 second mortgage payment goes away. So effectively, they've lowered their overall monthly mortgage payment after that point. But what it does do, when you compare apples to apples with the old program that we had, where we increased the entire loan amount by 30 to 60 basis points, that borrower, if they stayed in that property for the life of the loan, would have paid approximately $6,700 in interest over what they would be paying now with the new program. So it is a terrific savings for the homeowner. When we started on October 1st, we looked at applications. Realizing that lenders were taking applications every single day, we had to have a day that, okay, a date, if the application was taken on October 1st, it would be with the new program. Anything prior to that would be the old program with the grant as the down payment assistance. So we realize we don't see files because they're processed at your offices for about 30 to 45 days. So we know that even today in mid-November, we're still seeing a few come in under the old program because there are some new constructions out there, that type of thing. And that's fine. Those will eventually go away. And we only have the one program, which is the Great Choice, the first mortgage. The Great Choice Plus is the second mortgage if they need down payment assistance. And then we still have the homeownership for the Brave Great Choice. That will always offer that 50 basis point rate reduction on the first mortgage product. Now, that product can also have that Great Choice Plus to it. So it could be a homeownership for the Brave Great Choice and then a homeownership for the Brave Great Choice Plus, which would mean that that veteran or eligible homeownership for the Brave applicant would have the opportunity to get down payment assistance if they were not doing a VA loan possibly, or maybe they're doing a VA loan and they just need some closing costs. So that's going to be available to them still as well. Again, the interest rate currently right now is at 4.45% for 30-year fixed rate. So that means at the homeownership for the Brave on the first mortgage is at 3.95% right now. Our rates are always on our website. They are always in the top right corner of the home screen for the website. So if you're taking an application, you want to make sure you're current on the rates. Go there so that you can plug the correct rate in for your applicant into your application. The Great Choice Plus is the second mortgage, 4% of the purchase price at a 0% interest rate for 10 years for down payment and closing cost assistance. We've already had one rate in interest rate reduction, which is to the 4.45. We started this program out at a 4.6. Typically, THDA, as you know, does not see changes in interest rates all that much because we fund our loans through mortgage revenue bonds that are issued. We do those in large bulk, $1 million amounts, and we use those funds as we have that issue. We go back to the market to issue new bonds when we need additional funding. So that's why we don't see changes in our rate quite as much. But it's still affected by the outside market. So when we do go out to the market to issue new bonds, depending on what the bond market is, will reflect in our interest rate changes. Now keep in mind, prior to October 1st, our product was a grant. So there were not two liens. This change makes it a first mortgage and a second mortgage, so there are two liens on this property. Not much else has changed in the underwriting of this loan because all we're changing is the down payment and how we source those funds through that second mortgage. We still have our maximum household income limits, which vary by county. We still have our acquisition costs, which vary by county. All of those, you can find that information on the website. Our maximum LTVs on the loan products that we offer are based on what the insurer or the guarantor's guidelines are. For instance, FHA's max at 96.5, VA can go to 100%, USDA, RD as well. Now, conventional loan products, we do not do conventional loan products that are insured. Therefore, we cannot do a conventional loan higher than a 78% LTV. We don't see too many of those, but occasionally we will, and sometimes there are products out there with our nonprofit partners currently in different markets that offer a second mortgage large enough to do a conventional first with us. So it's an opportunity for those homeowners to avoid expensive mortgage insurance. So we will layer those. So keep in mind when you're looking at our loans that there are opportunities with other localities, with nonprofits that might have some layering that THDA would allow them in second or third position. Our interest rates are always fixed. They are subject to change, but as I said, not as readily as you might see in your markets on a daily basis. It's always a 30-year fixed mortgage. We never have any prepayment penalty on that. We do not do adjustable rate mortgages. It's 30 years fixed. That is the most sustainable type of mortgage for someone to budget, especially when they're a first-time home buyer. Loan types, again, FHA, VA, USDA, the conventional with the limit of 78%. And as the loan type is chosen, what the mortgage insurance or guarantee is required is what we require on our loans. Underwriting criteria, we have to manage to the insurer's guidelines. When the file comes into us, it's already been through DU or LP. It has to be an approved eligible, with only the exception of a manual underwrite because they have no credit scores. You follow the standard alternative sources of credit when we are doing a manual underwrite. We are underwriting to the IRS tax code. The IRS tax code is what gives us the rules to follow to be able to use the funding source of tax-free mortgage revenue bonds for these mortgages. So we have to comply to that. When the lender puts their file through DU or LP, we are going by that decision engine. So that decision engine comes with the package. The only other overlays that we would have on our loans, besides our IRS tax code criteria, would be our minimum credit score of 620. If it's only got 2 scores, it's the lower of the score. If we have 3 scores, it's the middle score. And the other overlay we have is a maximum debt to income ratio of 45%. Now keep in mind, because we have a second mortgage payment now, you do have to include that second mortgage payment in your overall debt to income. There are no buy downs and no co-signers allowed on any of the THDA loans. Our loans are assumable. I want to explain that a little bit because, as most people know, VA, FHA are still assumable with qualifying. Well, not only would those loans qualify under the insurer's guidelines or the guarantor's guidelines, but if a seller had a THDA loan and they were offering it to be assumable to the next buyer, that next buyer would also have to meet the IRS tax codes that we require as if it was a brand new purchase. So they'd have to be a first-time home buyer, they'd have to hit our income limits, our acquisition cost limits, and that type of thing. We don't see too many of those, but it is allowed and it is out there. Prepayment penalty, we do not have any prepayment penalties, whether it's the first or that second mortgage. We are subject to recapture tax, and you can get more information on recapture tax on our website. But just so you know, several things have to happen all at once for a borrower to be subject to recapture tax. The recapture tax is not monitored by THDA itself. It is reported by the borrower when they're doing their returns, when they sell the property to the IRS. The required reserves, it's based on loan type. Whatever the loan type and the insurer or guarantor's guidelines are, is what is required as far as reserves on our loans. Minimum investment as well is required by loan type. Closing costs can come from the borrower, the seller, a gift, or as required by the loan type. When closing costs can come through our second mortgage, which is our Great Choice Plus, which can be either used as down payment or closing costs or a combination of the two. If a borrower is getting down payment assistance through our second mortgage product, or if they are getting the interest rate reduction because they have qualified under the Home Ownership for the Brave, our 8-hour home buyer education class is required. A borrower can go and get that within 1 year, within a 12-month period, and purchase a home and use that certificate. It's an 8-hour class. We have on our website our educators that are certified to teach that class in all different areas throughout the state. They offer them in the evenings. They offer them on the weekends. You just need to find out where you're living, what's most convenient for you, and call and sign up. Our fees on these loans, the allowable fees, on origination fee, on the first mortgage, the lender is allowed to charge up to 2% maximum on origination fee. They are allowed up to 1/4% maximum in discount fee and an application fee up to $850. Other closing fees are normal and customary, and there are other closing fees that are standard for the industry, and THDA requests that they remain normal and customary. On the Great Choice Plus second mortgage, the borrower cannot get our Great Choice Plus second mortgage unless they get our first mortgage, which is the Great Choice loan. You can't separate them. One comes with the other. You meet the same maximum household income limits, the same acquisition cost limits, all of that applies. Our loan amount, the maximum it will ever be is 4% of the purchase price of that property. The interest rate is always 0%. It's amortized over 10 years, and there is no lender's title policy required by THDA on the second mortgage. There are questions as far as what fees are allowed to be charged on that second mortgage, and THDA allows a closing fee not to exceed $100. They also recognize that there are going to be recording fees, and there are certain fees that they may be exempt from being charged. Stamp tax, transfer tax, because the down payment assistance is funded through THDA, which is considered a nonprofit of the state, that tax is typically exempt. We still have the same underwriting criteria. One follows, the second mortgage criteria follows the first mortgage criteria. So we've got the 620 credit score. You've got to make that mortgage payment on that second included in your housing ratio, and they have to meet all of their underwriting criteria. There is a separate second mortgage note and deed of trust in the name of THDA for the second mortgage Great Choice Plus. We have those on the form section of our website. We have opened those up so that lenders can actually put those documents in their own loan origination systems software to make it easier for them to use to get those closing documents together. The lender closes on the loan after they get our approval. They close on the first and the second mortgage, and they fund them at the table. Along with the down payment assistance Great Choice Plus second mortgage, once the commitment is provided by the underwriter, the lender also receives what we call a legally enforceable obligation letter. That is for those loans that are getting the Great Choice Plus second mortgage. The borrower will sign that at closing, and that needs to be sent back with the closing package. That is for the lender to show to HUD that the down payment assistance that they pre-funded, but THDA funded within typically 7 days of the closing, THDA is legally obligated on that particular loan to provide those funds. That secures that portion of HUD's requirement for the mortgagee letter 2013-14. There are no prepayment penalties on our second mortgage. The second mortgage loan is due in full upon the first mortgage payoff, whether it's a sale or a refinance or an assumption. We do not allow anyone to assume the second mortgage, and we do not allow assumptions of the second mortgage. The servicing is done currently by U.S. Bank. That's who our current large servicer is. They are the same servicers who offered the stimulus second mortgage loan product in 2009 and 2010 when THDA had that available. So they are used to taking one payment from the borrower, separating them, and remitting them accordingly to the first and the second mortgage. Questions and answers. We put together the common questions and answers that we had been getting as we were developing the program. So we've talked a little bit about this, but could a borrower apply for down payment assistance only? No. If you're getting Great Choice Plus with down payment assistance, you have to have the Great Choice first mortgage through THDA. Will the rate on the first mortgage increase if I get a second mortgage for down payment assistance? No. The interest rate on that first mortgage, whether you need the down payment assistance second mortgage, the Great Choice Plus, or not, you're going to have that same first mortgage rate that we advertise on our website. There are no charges for interest rate locks when a loan comes in our door and we register the loan, meaning that all of the processing documents for submission are correct. Then that loan is locked into that rate when it hit our door. It will close at that rate, assuming that it gets a full commitment. That is for standard resale properties. On new construction, we do a rate lock for 180 days based on the average 6 month of new construction. Now, we will require documents to be updated near the end of that new construction period, because we have to follow the documentation expiration timelines that our insurers provide. How will I know if my interest rate is locked? THDA will send a commitment letter to the lender once the loan is approved through fax or email. They'll also send, along with that new legally enforceable obligation letter to reference the down payment assistance, Great Choice Plus mortgage, if that applies to the loan. THDA will not be disclosing on the second mortgage. The originating agent will be disclosing on the second mortgage as they disclose on the first mortgage. So they will be preparing a good faith estimate, they will be preparing a second HUD, and they will be preparing a truth in lending. They will combine that with their first application, with their first good faith, with their first truth in lending on the first mortgage. We will receive those documents when they upload that mortgage into our system for us to approve. Those second mortgage documents will be uploaded as well. So again, the OA will have to generate the truth in lending, the good faith estimate, the HUD 1, and the 1003 on the second mortgage, as well as the 1003 on the first. This is the same process that we offered when we did that stimulus loan in 2009 and 2010. Will there be 2 payments required from the borrower? There are 2 payments, yes, but the borrower can combine those payments and send 1 check or electronically remit 1 payment through their bank to our servicer, and then the servicer is managing that and separating with the first and the second. And a borrower is delinquent if they are not making both payments each month. They cannot just make their first and not send their second. The entire loan will be considered delinquent if that second mortgage payment is not there as well. The note and deed of trust for the Great Choice Plus second mortgage will be prepared by the originating agents, along with the Great Choice First Mortgage Note and Deed of Trust. They're downloadable from our website under Loan Documents section. The title company or closing attorney's offices will prepare them accordingly. There are writable forms so that they are easily fillable by our originating agents. We're trying to make it as easy as possible. I wanted to go over just a few things that are a little bit more general, but these are things to remember about THDA loans. And sometimes, I know you're getting information about every loan product out there, and sometimes it's hard to keep it all straight. So these are just a few highlights that some people don't think about quite often. On our Homeownership for the Brave loan, there's a couple different changes as far as, are you eligible for homeownership for the Brave? Are you also then eligible as a veteran under the tax code to waive your first-time homebuyer rule? There's slight differences in those 2 eligibilities. We are a little bit more lenient on THDA's side to offer that homeownership for the Brave interest rate discount. We include the National Guard. We aren't as restrictive on the active duty requirement. But when you look at the tax code to waive the first-time homebuyer rule for eligible veterans or spouse of a veteran, active duty military personnel, it's a little tighter than THDA's homeownership for the Brave. So you want to make sure you're looking at both of those if you're planning on combining those 2 together for a borrower. We have several targeted counties throughout the state, and those are counties that, since the early 80s and 90s, have been listed as economically distressed areas. Now, realistically, some of them have probably grown. Some of them that were economically distressed currently in today's market, we might not consider that, but they've been targeted that way. Their ruling has never changed, so therefore, if you were purchasing in one of those counties, you would not have to be a first-time home buyer. And of our 95 counties, 58 of them are targeted. So any of your borrowers buying in those 58 counties would not have to be a first-time home buyer. At the same time, in some counties, we call them partially targeted. That means that the overall county wasn't considered economically distressed, but there may be populations within the county or census tracts in the county that are considered economically distressed. So those are done by census tracts. Those are called targeted census tracts. There are sections on the website which offer you the opportunity to take a look at those areas. If you're sitting down an application with the borrower and they're telling you where they're thinking about purchasing, that can give you some ideas as far as, do they really need to be a first-time home buyer? Maybe somebody is coming in for a resale. Maybe they need to come to THDA because of credit score, because you might have a higher overlay than we would, and they really aren't a first-time home buyer, but they happen to be buying in a targeted county. So again, that first-time home buyer rule is waived. So that's always something to keep in the back of your mind when you're talking to applicants who may be second or third home buyers. They might still have the opportunity to use THDA. The other thing, we always talk about the first-time home buyer rule, but there's a few caveats to that. And for instance, if you had someone who recently moved within the past few years to Tennessee, they moved from another state, maybe they decided they couldn't sell that house that they lived in as their owner occupancy, and they decided to rent it. And if they had been renting here for 3 years, even though they still show that mortgage, the older mortgage, on their credit report, they still own that property, but it's now turned into an investment property, then they have not lived in that home as their owner occupancy residence for the past 3 years. So they could be a mortgage holder. They could be a landlord. And there's a benefit to that because they certainly have the experience of the cost of owning a home and budgeting and that type of thing. But they would be considered a first-time home buyer again, because here they had lived in a rental property in their owner occupancy. Please keep in mind that we are available for you, so you can call us. We have a specific line set up for single family, which is 615-815-2100. What we also have, which is just working so well, is we have our own Ask email line. So it would be sfask@thda.org, standing for Single Family Ask. We get questions in that email. We have about 7 of our senior staff in all the different areas, whether it's closing, servicing, underwriting, processing, answering those daily. And so you will get a response within 24 hours on that. And they direct it to the appropriate person who can answer the question. It's been great during the transition from the grant program to our Great Choice program, and I highly recommend you use that email as often as possible. It is not strictly for lenders. It can be used by the public. It can be used by realtors, by our partners, our nonprofit partners. It is just a great place for us to track all those questions and make sure we're getting to absolutely every question and it's getting answered. So I encourage you to use that. We are going to end the webinar now. Please, if you have any questions, feel free to reach out to us at any time. Thank you.